The loan officer slides a pre-approval letter across the desk. $412,000. She says it like a gift. You look at the number for 4 full seconds before you say anything. You make $75,000 a year. After taxes, insurance, and your 401k contribution, that's roughly $4,300 landing in your account every month. The bank just told you that you can borrow enough to make payments that will run close to $2,800 of that, before taxes and insurance on the house itself get added on top. You do the math in your head at the desk, and the number that comes out doesn't match the number she just handed you. You take the letter. You don't sign anything that day. This is where it actually starts. Not at the closing table, but at a desk, with a stranger, who gets paid whether you struggle for the next 30 years or not. Here's the number nobody explains clearly enough. Banks approve mortgages using something called the 43% rule. Up to 43% of your gross monthly income can go toward all your debts combined, mortgage included. On $75,000, that's roughly $2,690 a month, gross. It sounds reasonable until you remember gross isn't what lands in your account. Gross is the number before the government takes its share. You run your own math that night at your kitchen table. Take-home pay, $4,300 a month, a number you actually trust, because it's the one that shows up. You decide, on your own, that housing shouldn't eat more than 28% of that, a rule older than the 43% one, a rule from back when banks were more conservative about lending money they'd have to eat if it went wrong. 28% of $4,300 is $1,204 a month, for principal, interest, taxes, and insurance combined. At current rates, that payment supports a mortgage of roughly $185,000. Add your $22,000 down payment, and you're house shopping in the $200,000 range, less than half of what the bank just told you that you could have. Your brother Nate finds this hilarious. Nate makes $71,000, close enough to your number that the comparison writes itself. Nate gets approved for $398,000 the same month. Nate does not run his own math. Nate buys a house at $385,000, 4 bedrooms, a finished basement, a 3-car garage he fills with exactly 1 car, and a lot of boxes. Life's short, Nate says, standing in his new kitchen with the granite still smelling faintly of sealant. You're being paranoid. You buy a 3-bedroom ranch for $208,000, built in 1987, a kitchen that needs new counters eventually and doesn't have them yet. Your mortgage payment, all in, is $1,150 a month. You move in on a Saturday. Nate helps you carry a couch up 2 steps and says, not unkindly, "This is it?" You say yes. It is. Year 1, nothing dramatic happens, which is the whole point of the math working. Your payment doesn't change. You put $300 a month into savings without noticing much of a squeeze, because the house was never sized to swallow the whole paycheck in the first place. Nate's payment is $2,650 a month, once you add his taxes and insurance, which run higher because his house appraised higher. He also financed a truck the same year, $640 a month, because a man with a 3-car garage feels a specific kind of obligation to fill it. Between the two, Nate is putting almost $3,300 a month toward things that don't move and things that depreciate the second he drives them off a lot. Year 2, the furnace in your ranch dies in January. $4,200 to replace. You pay it from savings without a second mortgage payment's worth of stress, because the gap between what you could have spent and what you did spend has been quietly filling an account for 2 years. Nate's water heater goes the same winter. He puts it on a card at 22% interest, because the emergency fund he meant to start never quite started, not with $3,300 a month, already spoken for before groceries. Here's the part nobody warns you about at the pre-approval desk. The bank's number and your number aren't measuring the same thing. The bank is measuring what you can technically pay without defaulting. You should be measuring what you can pay without your life quietly disappearing into it. Year 3, Nate gets a rough quarter at work. Company-wide bonuses cut. His by $6,000 he'd already mentally spent. He doesn't miss a payment, he just stops doing anything else. No trip that year. A birthday party for his daughter that used to have a bounce house now has a cake and a piñata. He tells you at Thanksgiving, half joking, that he sometimes checks his account before pumping gas. The way you did back in college. You don't say anything. There's nothing kind to say to that out loud. Your own number moves the other direction. Your $300 a month, left alone for 3 years, has become a genuine cushion. Not enough to retire on, enough to mean a bad month is a bad month, not a crisis. You refinish the kitchen counters yourself that spring, $900 in materials, a weekend of work, because you can afford to wait for cash instead of financing granite you don't need yet. Year 4. Your mother gets sick. Not catastrophically. A surgery, a recovery, a few weeks where somebody needs to be around. You take 2 weeks off work, unpaid, because your job doesn't offer family leave for something like this. You don't think twice about the money. The math from 4 years earlier is the only reason the decision that week was about your mother and nothing else. Nate wants to help too. Nate can't take unpaid time. Nate's mortgage and truck payment don't pause for anyone's mother. He sends flowers instead, feels genuinely bad about it, and you watch something pass over his face at the hospital that isn't about your mother at all. It's about a version of freedom he doesn't have, standing right next to him in a waiting room, wearing the same jacket he's always seen you in. Your mother recovers. Life goes back to something like normal. At a family dinner that spring, your father, who said almost nothing about either of your houses in 4 years, mentions, almost offhand, passing the potatoes, that he sold his own house in '94 for less than what he could have technically borrowed against it, back when a broker told him he was leaving money on the table. Everybody kept telling me I was being small, he says. I just never liked the idea of a bank telling me what my life was supposed to cost. He'd never told you that before. You'd just assumed the modest house you grew up in was all he could afford. It wasn't the ceiling. It was the choice. You're still in the same ranch, 5 years later. The counters are done now. The mortgage is $1,150, unchanged, while your income's crept up around it, which means the same payment is a smaller slice of a bigger number every single year. Nate's refinanced twice, trying to lower his payment, and it still eats more of his month than yours ever has of yours. Neither of you got the 4-bedroom, the truck, and the untouched garage without a cost attached to it. You just paid yours up front, once, at a desk, saying no to a number a stranger handed you like a gift. Nate's still paying his, a little every month, in a currency that doesn't show up on a mortgage statement at all. Sleep, options, the particular freedom of not checking an account before pumping gas. The bank's number was never wrong. Exactly. It was just never yours to begin with. It was the most house you could survive owning. Nobody ever asked whether surviving it was the same thing as living well inside it. And the only person who was ever going to ask that question was you, at your own kitchen table, with your own math, on a night nobody else needed to know about.